Welcome to my market commentary and our third quarterly review of 2024. Welcome back aboard the roller coaster, folks. It really has been an eventful and at times concerning quarter. In America, the ex-president got shot, whilst the current one called the Ukrainian president Mr. Putin and then dropped out of this year's presidential race for the White House. In the UK, there was a swift change of government, whilst violence dangerously continued to escalate in the Middle East. North and South Korea continued to threaten one another at an alarming rate, and then Ukraine invaded Russia. All of this has been set against a backdrop of central banks trying to unravel the past few years' inflation crisis post-COVID. In early August, the Japanese central bank pushed interest rates up to try and stave off their own surprise inflation. This strengthened the yen, which is their currency, which then obliterated the carry trade. Now, the carry trade is used by traders when a particular country, in this case Japan, has a low interest rate. The traders are able to borrow money from this low interest rate country and then invest it in another country where rates are higher, such as in US Treasury bonds. This works swimmingly well, unless the lending country suddenly strengthens their currency, thus wiping out the carry trade profit. Fortunately, the yen dropped back in the following 24 hours. In the meantime, however, markets overreacted completely to US joblessness data. I issued an emergency bulletin to all of our clients entitled "Nothing to See Here," where I argued that the data was being viewed in isolation and an imminent drastic US recession was not on the cards. Sure enough, the markets caught up with this view and so started piling money back in to the US and global equity markets last week. Our portfolios held up well over the past quarter, particularly in the more cautious risk strategies. This was because the underlying bond funds finally received attention from panicked equity sellers. We call this a flight to quality. Bond funds still stand to benefit from notable interest rate cuts when they finally arrive. The US Central Bank, that's the Fed, are due to make a rates decision on the 18th of September. We believe that this meeting could be pivotal in either pushing markets on up or spooking them once more. This is why our TNT team have worked hard over time in the past weeks to get your review out to you that little bit sooner. We want to be sure that we are ready. The other date that we'll be watching is the US presidential election on the 5th of November. Once again, we want to make sure that we're prepared. In particular, we've invested time in researching the underlying exposure of each of our clients' funds to US Treasury bonds. A Trump victory could be good for US equities, but may cause US Treasuries to slump due to his planned tax cuts, deregulation, and infrastructure borrowing. Now, we've run your review up until the 12th of August this time. This is earlier than usual to allow us to fully test the portfolios in readiness for these key dates. Interestingly, the markets, and therefore all of our client portfolios, have risen notably in the past week at the point of writing since we put our figures together. So these rises are not taken into account in the figures you'll receive. We need to make one tactical but important change within our level 3 and level 4 mainstream portfolios. We also shall be rebalancing all of our clients' proactive portfolios at this time to bring things back into line once again. As ever, we're only a phone call or email away if you need anything at all. These are strange times, but actually a pattern is starting to emerge and we can see real opportunities for investment portfolios to grow further in 2024 if conditions allow. I really hope you enjoy your reviews and my very best wishes as ever.